Is the market headed for a reality check? Joyce Chang warns of stagflation and urges caution as risks mount. Stay to the end as Chang reveals which sectors could still thrive and why gold might be your best hedge in a tricky market environment.
We're still at around 6,000 for the S&P 500, so I think you're in a range here. You have slower growth coming, and we think higher inflation, but you also have that there's been very steady retail demand and buybacks. I mean, we've been looking at $7 to $8 billion of demand daily into equity markets. So the technicals could still squeeze this higher, but we're on a stagflationary tilt here. So I would just be careful on calling for a much higher market here.
You know, I had to just check. You said 6,000. So you see the market pulling back quite significantly in the back half of the year.
It could. I think you will get the slowdown. Now, we've had a lot of front loading, a U.S. import surge, but we're still looking at an effective tariff rate that's 14%. That's a $400 billion tax.
You know, it's funny. I spoke to Gene Soroka from the Port of L.A. Long Beach yesterday. He did say that import volumes are slowing down. So we are starting to see that. Not clear if that's because of front loading and people have what they need or just they're kind of concerned about tariffs. Not really clear there. We also heard from Raphael Bostic, Atlanta Fed president, speaking with our European colleagues this morning. I want to play a soundbite from him when it comes to tariffs and get your opinion.
The textbook story for economics is if you do tariffs, it's a one-time shift. It happens quickly. What we are seeing today, though, is not just a one-time shift. It's actually something that's being stretched out over a much longer period of time. I think that runs the risk that people start to feel like inflation is always with them. This elevated level of inflation is always with them. And that then runs the risk that there might be some structural changes that businesses and consumers, for that matter, make.
So it sounds like you two see things similarly, a potential stagflation environment with higher inflation due to tariffs. With that in mind, if the tariffs create stickier inflation, what parts of the market actually work? Because it doesn't sound like you think everything goes down. It sounds like there's different parts that work and different parts that just don't work.
Well, I do think that the term premium here is going to stay elevated because of the fiscal debt, you know, the one big, beautiful bill. But GDP growth, I mean, we think it's going to slow down to sub-trend. So looking at going from, you know, the fourth quarter, if we were around 2%, going to 1.3%, still a 1 in 3 chance of recession here. So I think that, you know, when you're taking a look at the sectors, I mean, certain things like aerospace and defense are going to do well, but we still think that you should be more in consumer staples, utilities, you know, real estate here. And I think the international markets could continue to outperform here.
So you're mentioning aerospace and defense. A lot of talk about that in recent weeks, obviously, just because of some of the geopolitical tensions. I want to show a chart. If you look at the European Aerospace Defense ETF, the EUAD, compared to the ITA, one that we track really here, they're trading pretty closely since then. You can see that they're pretty much neck and neck right now. We also heard from the European Commission president. Our European colleagues spoke to him saying that some of that spending that they're doing there is going to go to U.S. companies. So with them kind of neck and neck right here, which sector seems more attractive? Is it U.S. defense stocks? Is it European defense stocks? I'm going to ask you about, you know, emerging markets, developed markets, and U.S. stocks going ahead. But just specifically when it comes to defense, which one seems more attractive from here?
I mean, look, I think that in Europe, you also have to take a look at the currency. I mean, we still see the weaker dollar here as well, and the euro is going to do better here because a lot of this fiscal spending will be more front-loaded. So I still think that there's, you know, a reason to look at Europe right now, just given that what they are doing at NATO is historic, even though it's going to play out over a period of time on the defense spending.
What about the bond market? With the one big beautiful bill passing, are you expecting to see bond yields move to the upside? And does that upside move create competition for equities that also puts pressure on them? I
mean, there's always some crowding out when you look at where yields are at in the U.S. But I think that this is one area where the fiscal considerations are in some ways even like outweighing some of the monetary policy effect that could come into play. So I look at term premium to remain elevated here. It's not just the fiscal deficit. It's also what the Treasury funding needs will be. And we think that's covered for this year. But we see beginning in 2026 about a $5 trillion gap that begins to emerge when you look through the rest of the decade.
All right, we got to get going, but I got to ask you about one more thing. Your gold outlook. You see gold getting to $36.75 by Q4, about 11% upside from here. So why are we just all investing in gold? Why are we wasting our time with these equities?
I mean, when we talk about, you know, recession risk, stagflation risk, I mean, gold is still a very good hedge. And, we've done a hypothetical, and granted, it's just a hypothetical, but if you did just a 0.5 percentage point increase in the gold holdings over the course of the next 4 years, I mean, you could be looking at gold prices that could go hypothetically all the way to 6,000. Now we're thinking 4,000, next year, but it's still a good hedge